Welcome to our session on financial statement analysis. Today we're going to explore how to use financial ratios and related tools to evaluate a company's performance. Financial statement analysis is essential for managers, investors, and lenders to make informed decisions. Whether you're a company over time or against its peers, these tools can reveal strengths, weaknesses, and opportunities. The key topics we're going to discuss here, which are about ratios themselves, something referred to as common size statements and percent change statements. The DuPont equation will also be discussed, as well as some of the limitations and other factors that we need to consider when we're analyzing a company. Our big picture model is the connection from our evaluation of the firm's performance and outcomes to the value of the firm. So financial analysis gives us the insight into actions management can take to improve operations and firm value. Ratios help us to compare companies over time and against industry benchmarks. They are used by lenders to assess creditworthiness, stockholders to estimate risks and returns, and managers to pinpoint areas of improvement. For example, think about comparing Amazon's profitability against Walmart's. It's not just about revenue, it's about efficiency and costs. Profitability ratios measure how efficiently a company generates profit relative to its sales, assets, or equity. For instance, the profit margin shows what percentage of sales translates into profit. Take Apple. Its net profit is consistently higher than many peers, reflecting superior pricing and operational efficiency. So profitability allows us to review how management controls expenses. It could be in relation to sales, it could be in relation to assets. We can also review the outcome using investment dollars to create sales and income. So the balance sheet items can also be utilized in using this profitability analysis. What we look for are trends and outliers. We expect stability, certainly not decreases. So what do these ratios tell us? Well, they give us an indication of how well the company controls expenses. Gross profit margin, as you see the numbers here, show that over the last several years have been relatively flat. Slight decrease over the last couple of years, but in general, they have been stable, moving in the same direction, if you will. Operating profit margin shows how they control the expenses of running the entire company. So in year 4, there was a decline in the control of expenses. Expenses might not have increased, but sales may have declined. So again, we would want to analyze why did the sales in that particular year, why did they fall so much? What happened to our control? And likewise here with net profit margin, and you can see it's a pretty volatile kind of movement, but in general, they mimic the operating profit margin. So we could probably say that there must be something going on with some expenses. It could be the amount of sales, or it could be, again, the actual controlling of expenses like marketing, research and development, etc. We can also look at profitability with respect to assets. Again, stability is the importance that we're looking for here. The basic earning power is a very powerful ratio. It reflects the operating profits generated from the assets of the company. The company buys assets to do a job. The operating profit is the amount of profit that is created from using those assets. What is that percentage return? And again, as you can see here, the numbers do vary pretty much, right? They're moving all over the place, but it does seem to have a general upward trend over the last couple of years. Return on assets reflects the net profits generated by the assets of the company. The challenge here is comparing to competitors in the industry, because this number includes financing. If the companies or the industry in general has a different debt level, profits will be different because of interest expense. So the ROA is influenced by the company's financial strategy. Return on equity provides a gauge of profits generated relative to the investment of owners. As you can see here again, we have some variability, but in general, there seems to be some upward trend over the last couple of years. So what are the effects of debt on ROA and ROE? And so leverage can amplify returns on equity. We'll actually show this in a technique later in these videos. Although debt reduces net income through interest expenses, it enhances ROE if equity is reduced more than its net income. This is why Tesla's aggressive leveraging strategy can boost shareholder returns when used effectively. But it also carries risk. So which ratio is better? ROA is impacted by the debt of the firm. It is therefore a poor ratio to compare to competitors of an industry. There's a saying, it's always better to use other people's money than using your own. So leverage has a huge impact, not only on expenses, but also on the returns to our investors. We have some additional ratios having to do, relating to profits. The operating profit ratio, again, reflects the control of operating expenses. This ratio is very similar to EBIT divided by sales. Very similar. And as you can see, the orange line, it is fairly stable, although it has been somewhat declining over the past couple of years. The operating capital ratio reflects the assets used to create the sales. This is considered an efficiency ratio. And if you look at the operating profit ratio again, you can see some general incline over the past couple of years. So what this tells us is we are using our assets better in generating sales. ROIC, that puts the profits created from investment and looks at those profits to compared to the dollars. As you can see, the numbers are quite large, especially in the third and fifth years here. So we definitely have some type of an increase in ROIC over the last 4 years. Of course, we know something did happen in 2020 that could have an influence on all of these numbers. What are asset management ratios? They show how well a company uses its assets. For example, total asset turnover tells us how efficiently A company generates sales from its assets, all of its assets. That includes the tangible and the intangible. Amazon, with its extensive logistics network, demonstrates high efficiency compared to traditional retailers. So these numbers can reflect both short-term and long-term efficiency. When we look at short-term efficiency, the first ratio we can talk about is something called Days Sales Outstanding, DSO. This represents, on average, how long it takes for customers to pay for their purchases. Obviously, we like this to be closer to 30 days. And again, looking at our graph, we can see that the company is fairly stable over the last 5 years with its control of receivables. Days inventory carried, that's the number of days inventory sits on the shelf. And we want this to be within reason, but a number that is too big means we have too much inventory. A number that's too small means we don't have enough inventory. And again, over the last 5 years, we can see that this number has been fairly stable. So our management, the efficiency with which we're managing our accounts receivable and our inventory has not changed. We're very stable with respect to this. Days payable outstanding, though, again, this tells us the average time it takes us to pay our credit. And we can see that from 19, 20, and 21, there was some very big slowdown for this company. Now, this ratio is sometimes clouded by some of the data that's provided by companies and the ratios themselves. But we can see that over the last 2 years, we have come back into a much lower number. Still, it's very high, 158 days. I'm sure that is not really the standard. But again, the data basically shows us that there is some variability in our paying our bills to our creditors. How we can combine this analysis is into something called the cash conversion cycle. It creates two things. The operating cycle is the combination of days sales outstanding and days carry inventory. So in other words, in 2023, it roughly took 67 days from the time we purchased the inventory for our production till the time we actually received the money from the accounts receivable. Almost 2 months from beginning to end. If you look at the cash conversion cycle, now we subtract out the days payable outstanding. And if you remember, this was a very large number. So we end up with a negative cash conversion cycle. So what is our goal? The lower the number, the better. Negative is not bad, but these numbers are big. So this could be an indication that we are slow paying our creditors. We may, as management, want to take a look at this because our suppliers are going to look at this and say, hey, you're buying stuff from us, but you're not paying us back very quickly. So there may be some implications to this particular strategy. When we look at long-term efficiency, we're looking at the fixed asset turnover ratio and the total asset turnover ratio. This looks at the question of how we manage the asset base. Do we have enough or too much in the way of assets? And the outcome here is difficult to change because we need to sell assets if we think we have too much. And of course, then we have to buy if we think we don't have enough. What would be causing those things? It could be caused by the economy. So this is a very tricky question of how to fix this particular ratio. But as you can see, again, from the graphs, we are stable. There is not much improvement or decrease in either one of these numbers. So with respect to how well we're using our plant and equipment and the other assets of the company, we can state that we are stable. We're staying in the ballpark, if you will. Is this a good number or a bad number? I mean, a more complete analysis would require us to compare this either to the industry, or maybe we pick a competitor and compare it to the competitor. That would tell us at least where we are relative to an average number, if you will. Thanks for listening to the video. I'll see you in the next one. Bye-bye.